Okay, let's go. So starting off the chapter 10 that we were looking into in the previous session. In this particular class, we're looking into go a little more in depth into this. So starting off with the consideration payable to customer. We just touched upon it yesterday. We will slowly look into a little more detail on this one here. Okay, so let's first simplify it and let's get to a simplistic understanding about this. When we talk about consideration payable to customer, so what it includes is that the seller is paying to the customer. What is happening here is the seller is paying to the customer. I'll give you an example. That I went to a shop and I told, please keep my soft drink. What did the shopkeeper tell? That, okay, I'll keep your soft drink, but I don't have a fridge. I was like, okay, you pay me for the good soft drinks. I'll buy you a fridge. I'll give you a complimentary fridge as a gift. Or I'll pay you for the fridge. You buy a fridge, I'll pay you for that. Or I'll reduce that much from your selling price. Whatever you have to pay me. You buy a fridge and you keep my soft drinks. So these are one example where you are as a seller paying back to the customer, right? The manufacturer of that soft drink is paying to the wholesaler that I'll put a fridge in your shop and you keep my soft drink here because I want people coming into your shop to look at my soft drink and try my soft drink. Okay, so that is one simple example of consideration payable to the customer. Okay, that is one example of consideration payable to the customer. Okay. So customer payments, the reduction of revenue, right? In a way, it is a reduction of revenue because the seller is saying that whatever you pay me, I will, you can net off the price of the fridge, right? You buy X amount of goods, I will reduce the price of a mini fridge for you. Okay. So that is about this, that customer payments, it's a reduction of your revenue, right? And it relates to, yeah, example, as you can see, purchase transaction, shelf space example. If you look into shelf space, a shelf space example, you can look into it as a shelf space example that I told you that you're paying for that particular person to keep fridge in his office so that in his shop so that he can keep your goods. So payment made to customer usually reduces the transaction price unless they are for distinct good or service. So generally how you treat it is that it reduces the transaction price. That means if you purchase 10,000 the soft drink bottles from me, you have to pay for the 10,000 soft drink bottles. But I have told you to keep a fridge and you buy a fridge, whatever it costs for the fridge, I've reduced it from the price of the soft drink bottles. So generally that is the treatment unless they are for a distinct good or service. Unless they are for a distinct good. That means if you're buying separately something from the customer, then it's recorded separately. For example, I sold something to him and I purchased something from him. Then it is for a separate goods or service. If it's for a separate good or service, then you have to record it separately. If it's for a separate good or service, you have to record it separately. Okay, if it's for a separate good or service, you have to record it separately. If you have to separate good or service, you have to record it separately. Okay, if it's for a separate good or service, you have to record it separately. Okay, if it's for a separate good or service, you have to record it separately. Okay, if it's for a separate good or service, you have to record it separately. That's it. Unless otherwise, it will just be a reduction in your transaction cost. Okay, done, finished. That is about this consideration payable. Okay. It will be a reduction in the transfer price unless it's for distinct good or service. Okay, unless it's for distinct good or service. Next, we'll go into allocating the transaction price. Okay, let's look into allocating the transaction price. Here, what you do here, you allocate the transaction price to the performance application based on the selling prices, right? So here, based on the standalone selling price, you will do an allocation. Based on the standalone selling price, you will do an allocation, right? So you follow the allocation principle based on the standalone selling price. What you do is you allocate the transaction price to each performance obligation based on the standalone selling price. Okay, based on the standalone selling price. It's better to just look through an example and do these topics rather than doing them theoretically. It will just make your understanding a lot more better. So let me do the TYUs now only rather than separately doing a video on TYUs. Where to do it now only. We'll start with the TYU one. We'll separately, simultaneously do the TYUs on this, so you will get a lot more clarity and confidence in this chapter. Okay, we look into the first illustration here, taking right from the start. On 1st December, Wade receives an order from a customer for a computer as well as 12 months technical support. So see, there's two performance obligations. First performance obligation is technical support. Second performance obligation is the computer. Right? There are two performance obligation. One is the technical support, one is the computer. Okay, one is the technical support, one is the computer. Okay, one is the technical support, one is the computer. Okay, one is the technical support, one is the computer. So you see here as well, there are two performance obligations. This is the illustration. You see two performance obligation. One is the computer, one is the technical support. This is step two is done. Okay. Wait delivers the contract to the customer on the same day. The customer paid 420. So this you can record as revenue. So allocating the transaction price first of all. So the customer paid 420. The computer normally costs 300 and technical support 120. So first step, what you have done, supply of a computer and supply of technical support. These are the two performance obligation. Okay. First step, there's an agreement between Wade and the customer. Okay. So we have a contract here. And then there are two performance obligations. What are the two performance obligations? Supply of a computer, supply of technical support. Two performance obligations. Next total transaction price is 420. This we finished step three. Step four is you are allocating the transaction price. 300 relates to computer, 120 relates to the supply of the what do you call it? The technical support. 120 is for technical support, 300 is for the computer. So at the end of the year, 300, obviously you delivered the computer. And how many months service have you given? So here 1 month service you have given. So totally 300 plus 10. 310 you will recognize as revenue. At the end of the year, total revenue will be 310. Why? Not 420. Even though he's paid 420, you have not earned 420 technically. Right? 120 relates to 12 months. So per month 10. 300 computer you delivered immediately. He paid you for the computer. So 300 is established. 120 is for 12 months. So per month is 10 and 1 month service is done before the year end. Before the year end, 1 month service is done because see, 1st December only you have purchased. So by the end, you have given 1 month service also. So totally 310 will be the revenue that you would recognize. So there's a contract between Wade receives an order from a customer. When you receive an order, that's a contract. Because you were offering the computer, he made an offer and you told them money and they agreed to it. There's a contract, offer, acceptance, and consideration. And three things are there: offer, acceptance, and consideration. Your shop is an offer only. You holding a shop is an offer only. You having a shop is an offer. They accepted the offer and they gave you an order that I want to buy this, and then they were okay with the price also. So when the order, acceptance, and consideration, all three are there, we have a contract. Second, there are two performance obligations. What will the shopkeeper do? Sell you a computer, give you technical support. How much is he charging? 420. 300 relates to computer. Computer you gave immediately, the 300 you can recognize revenue. 120 is for over 1 year of service. 1 month service you have given. 120 for 12 months, 1 month 10, 300 plus 10, 310 you will recognize as revenue. Okay, let's make sense of this here, Nandika, quickly. First of all, we'll take step one, Nandika. Do we have a contract here?
Yes, sir.
Okay.
We have contract between the and its customer. That's step one. Step two, we have the performance obligations. One being the supply of computer, and the second one being technical support.
Okay.
Step three is the transaction price. So the customers paid 420 on 1st December. That's the transaction price.
Very good.
And then allocating the transaction price to the separate performance obligations, which is $300 for the computer and $120 for the technical support.
Very good.
And last step being recognizing revenue as an obligated. So the computer is transferred on that very day. So to you have the first one, and the technical support is provided over the period of so 120 that will connect to employee also.
Right. Absolutely. So that is about the 5 steps. Okay. So that is pretty much all the 5 steps that we have figured. Okay. Then we looked into the first steps, all the theory of first step. We had an illustration here for the first step. So Monaco at the year end of 31st March 2006, on 1st January, Monaco signed a contract with the customer. So he signed a contract, for identifying the contract, to supply with them with an asset in return for the payment. So he will supply the asset, he will get the payment. So you signed a contract and there are the performance obligations that you will give the asset, customer will give you the payment. And control of the asset were passed on the same day. By 31st March, the result of the change in the economic climate, Monaco did not believe that it would probably be paid 360. It is now he says that climate has changed. In 1 year, the climate has changed. Is it 1 year? No. By March, so this transaction happened on 1st Jan. and the control passed on 31st March. In 3 months, the control passed. But on 31st March 2006, when the control passed, what happened was it was not probable that he will get the payment. Therefore, the contract cannot be conducted and no revenue should be recognized. Why should no revenue be recognized? Because no money can be realized. If you think that you cannot realize the money from the customer, don't record the revenue. If you think that you cannot recognize the money from the customer, don't record the revenue. If you think you cannot recognize the money from the customer, don't record the revenue. Okay, if you think you cannot get the money from the customer, don't recognize the revenue. If you think you cannot get the money from the customer, don't recognize the revenue. So the year end is 31st March. You signed a contract that you will give the asset, the customer will give you 360, control passed, but revenue should not be recognized. Why? Because it's not even probable that the customer will pay you anything. If it's not probable that the customer cannot pay you anything, don't recognize the revenue. If it is not probable that the customer cannot pay you anything, don't recognize the revenue. Okay. So if it's not probable that the customer cannot pay you anything, don't recognize the revenue. So here you see, it should be probable that you will get the money, right? It should be probable that you will get the money. Okay, where we had said this. Agree, enforceable rights can be oral, enforceable, absolute, contract recognition, yes. All parties approve, rights, cash flows collected, expected to be collected. So you see here, contract recognition criteria, you should expect to be collected. If you don't think you can collect it, don't recognize. So here you cannot collect it, right? They're saying 360, you don't think that you can collect it anymore, so you don't recognize it. Okay, clear, everybody? Do you understand? Why are you not recognizing 360? Because 360 is 100,000. You're not recognizing this. Why are you not recognizing this? Because he does not believe that it would be paid this. He does not think that the customer will pay. And if the customer is not paying, you should not recognize. Right? If it's not probable that the customer will pay, don't recognize this. Okay? So that is about this.
So I have a question.
Yes.
As per prudence, if you are not expecting income to recognize in this books, but on the other side, like the other party was supposed to pay the cost, so will they recognize the cost in their books of this 360? Yeah.
Okay. So the person buying, will they recognize cost of this?
Yeah, is it?
Yeah, in the P&L they will, in the cash flow they won't. Again, it's a probability that he will not pay, right? So
Yeah.
probability is subject to judgment. So the other person will put this as a inventory in their goods and they will recognize it as inventory at that amount. So the other person will. For the other person, the purchase is an asset. When the other person has purchased it, for them it's an asset. Under inventory, they will record it at 360,000. They will record it at 360. But in cash flow statement, this will not be shown as a cash outflow. In the P&L account is based on accrual basis. Cash flow statement is based on cash basis. In an accrual, in P&L account, since it's based on accrual basis, you will record it. Because for an accrual basis, only the economic event has to happen. The cash does not need to transfer. So the economic event has happened. This person has sold to him, the goods has been transferred, legal rights has been transferred. So the economic event has happened. Because the economic event has happened, you can record it in the P&L account. Because the P&L is based on accrual. So you will show it. But in the cash flow statement that we will study later on in the syllabus, there you cannot record this kind of a transaction. Why? Because it is no cash transaction happened. So because it's on an accrual basis, an accrual basis allows for a recording to happen the moment an economic event happens. It does not wait for a transaction to happen. Sorry, a transfer of cash to happen. So because the economic event of the legal title passing has happened, you should recognize, the other person will recognize it as an inventory. These people will recognize it as a receivable. Until it's confirmed that they will not pay, they will start to will continue to keep it, and when they think that okay, it's completely sure we're not going to get it, they will start to make an allowance for it initially, and later they'll write it off. When you're sure, they'll write it off. Initially they will start making allowance. So whenever, even if it's probable, both the parties will still record, because probability still has some amount of uncertainty in itself, right? Probability is only 75% sure. That means 25% still can be paid. Okay, so both the parties will recognize it. No worries. Okay, so this is about this. The second illustration done. Next, we'll look into the third illustration here, which was our agency. Okay. Hadrian Co revenue includes 45,000 for the goods it sold as an acting as an agent. So agent is someone who just meets the buyer and the seller. They don't own the goods. Of for offer. Offer is the principal. Okay. Hadrian is the agent. Hadrian, right? Hadrian Co is the agent. Offer is the parent principal. Hadrian Co is the agent. Offer is the principal. Hadrian Co includes revenue, includes 45,000 for goods it sold acting as an agent. Hadrian Co, excuse me, earned a commission of 10% of these sales and he sent 40,500 to offer. So how much he recognized? He recognized 10% of this. That is 45,000, 10%, right? So he recognized a certain amount here. 10% of 45,000, 4,500. He recognized 4,500 of these sales and remitted the difference, the remaining difference, right? He sent it back to offer. Okay, this is what has happened. He kept his 4,500. He kept his 4,500 and gave the remaining to offer. Okay. So now Hadrian Co should not have included 45,000 in its revenue in the first place because it is acting as an agent. Only the commission of 4,500 should be recorded in revenue. In case of Hadrian, it should record it only 4,500 as the revenue, only the net. The agent should only recognize the net revenue, right? After the remaining that is there, the 10% of 45,000, only this should be recorded as revenue. Okay. With the balance of 40,500 should be recorded as a liability until it is paid to offer. So 40,500 should be recorded as a liability and the remaining 4,500 should be recorded as a liability. Sorry, 4,500 is the revenue and 40,500 is the liability. They should record it initially. This is what Hadrian should have done. Okay. As offer has now been paid, the following adjustment is required. So what you're doing is you're removing from your revenue. You're removing from your revenue and you're crediting your cost of sales because they have told they have included it in revenue. Right? Hadrian revenue includes. So you have included in your revenue. So you're removing from the revenue. So you're reducing revenue to 4,500. So remaining you're removing and you're also reducing your cost of sales to nil. You're reducing your cost of sales to nil. Why? Because that also they have given it's included in cost of sales. It's included in cost of sales. So you're reducing your cost of sales also and you're reducing your revenue also. So ideally, what should Hadrian have done? He received 45,000, 40,500 in liability, 4,500 in revenue. And the moment it pays off that liability, then liability becomes zero, revenue will stay in their balance sheet. Here what they happened, they recorded it in revenue. So we are, now that they have paid off, we are reducing the revenue by 40,500 because they should have not been in the part of the revenue in the first place. Second, they're included in cost of sales also, so we are removing it from the cost of sales as well. This is the journal entry for principal and agent. Okay, let's make sense of this one here, Karan. How have you understood this one, buddy? What Hadrian did versus what he should have done?
I think the recorded revenue that sales is just an age. If you recorded one of the to the $4,500. Instead of recorded 45,000 as revenue, and obviously the remaining 40,500 as the cost of sales. You have to reverse that, therefore it's going to debit the revenue because debit to sale revenue and credit the cost of sales. You should have effectively considered as a liability in the balance sheet and then paid it off to Adrian. That's what I meant.
Okay, perfect. So you should record it 4,500 and send off 40,500 to the principal. And what the principal in the meantime, before it sends off, ideally initially it should have recorded as 4,500 as revenue, 40,500 as the
Yes.
liability. Okay, so that is about this. This is the illustration that is given as an idea about the principal versus agent. Okay, now let's look into the transaction price here. So yeah, we look into the transaction price and we'll understand the financing component or whatever there is in this particular question. Again, we got a theoretical understanding yesterday. Today, going through the TYUs, we'll just make that theory a lot more solid going into the next steps. So, Kima Co. enters into contract with the customer to supply furniture on 30th September 2003. Cost of the furniture transferred to the customer on that date. So, the economic event has happened on that date itself. Okay, the price was stated of the contract is 750,000 and is due for payment. Right, the transaction cost 750,000. So, there is a contract. Step 1, there is a contract. Step 2, performance obligations. What are the performance obligations? Supply the furniture. Step 2. Step 3, determine the transaction price. 750,000 is the transaction price. Step 4, allocate the transaction price to the performance obligation. There's only one performance obligation, that is the furniture. So there's only one, now no need to allocate. No. And fifth, recognize revenue once the performance obligation has been satisfied. Okay. So that is pretty much it. So here what has happened is the one person's obligation is met, is that they have given the furniture, have they cut off the furniture transfer to the customer on that date, 30th September only they have delivered it. And it's due for payment on 30th September 2005. So 2 years later it's due. So it's due for payment as on 30th September. So there's 2 years in between, right? Between the payment date and the transaction date, there are 2 years. If you see, between the payment date and the transaction happened in 2003, payment will happen in 2005. So whenever there's a significant time gap between 2 years, we say there is a financing component. What do we say? We say there is a financing component. Okay, between 30th September 2003 and 30th September 2005, we are saying there's a financing component. Why are we saying that there's a financing component? Because there is a time gap between the transaction date and the payment date. Because there's a time gap, we are saying there is a financing component here. Now they're asking, and the market interest rate is at 7%. So you have to use the discount rate as of 7%. This is why they have given this. And the 7% is the rate. Currently, rate of interest available in the particular customer, our market rate for the customer would be 7%. So now we will use that 7%. So what do we go about this? Is firstly, 2 years later, the value would be 750 because he's taking on EMI. We did this, logical question yesterday. So 2 years later, it will be 750. 2 years later, the total amount he will pay 750. But today, when we are recording the transaction, how much we should record it at? We'll discount it, right? We multiply it with the discount factor. 2 years discount factor you can multiply. So see here, you'll get the discount factor and present value tables. Okay. In the present value tables given in the question, given in the exam, in the exam, you see, this present value tables will be given in the form. The sheet here, present value table. So you go to the present value table and you take 7%. Is it, how much is it? 7% for 2 years. So you get 7% for 2 years. Okay, you take 7% for 2 years. Okay, and then you just multiply it with 750,000. Okay, so let's do this, buddy. 750,000 into 0.873. 750,000 into 0.873. 750,000.
6,41,550.
Yeah, so you're getting this amount? 650,079. You're getting this? Okay. There's a slight difference again, so probably due to the rounding off over here. So we have taken 3 decimals. Here they have taken only 2 decimal places when they are rounding it off. So it's fine. There's a slight difference if you get at all. So this is the amount that you will get. So this is how first initially you record it at. In 30th September 2003, you will record it at this amount. How much? 655. At 30th September, you will record it at this amount. When you purchased, initially, you will record it at this. Initially, you will record it at this. Now, 1 year passed by. They are asking, what will be first amount on 2003? So 2003, you have got the amount. 2003, you have got the amount. Done. Yeah. 2003, you have got the amount. This is done. Yeah. Let's make sense of this. Mukund, are we following, buddy? In 2003, what will be the amount? Let's make sense of that.
Yeah, it makes sense. You just working out what valuable.
Okay. So in 2005, okay. So in 2005, when you will pay, it will be 750. We are just discounting it for 2 years and we are bringing it to 655. In 2003, it will be at 655. How did we discount? We just took the 750, multiplied with the discount factor. We just multiplied with the discount factor. So we got 655. This was as on, this was as on, this was as on, this was as on 30th September 2003. Now they are asking 1 year later, what will be the amount? 1 year later. And they're asking in the books of Kima, that in the Kima, how much will be the account. So what happens is 1 year later, you will unwind it. This 665 will unwind. So calculate this 655,079 into 1.07. 1.07. How much is the total? 1.07. After just 1 year. 7 lakh.
934.
Yeah, 7,934 change. So this is your amount after 1 year. This is the amount after 1 year. Okay. This is the amount after 1 year. And this will be the amount receivable will be at this. However, you will also recognize the finance income of this. As I told you, there will be a finance income. Subtract these two. 7,935 and 655,079.
45,856.
Okay, 45,856. This will recover. You recognize it as a finance income, right? As the this will be an income, finance income. This will be your finance income, right? What is this? This is your finance income. What is this? This is your finance income. Okay. What is this? This is your finance income. Okay. What is this really? This is your finance income. Hmm. Okay. So you have to also recognize the finance income. After what you have to do is you have to also recognize the finance income. What you have to do is also recognize the finance income. All you do is you recognize it as a finance income. Okay. They got a finance income here. 45,856. So 655,079. 655,079. 655,079 becomes 7,935. 655,079 in 1 year becomes 7,935. Right? Because he'll have to pay in 2 years. Again, you do 7,935 into 1.07 again. In the second year, if they had asked the question and asked for in the second year, then how would you do? Just do this 7,935. It's 7,50,000. And that will be the total payment. When you do 7 lakh into 935 into 1.07, you're unwinding the interest. Anything at present value, as time goes by, you have to unwind it. So first, when you unwound it for 2 years, it was 655. As 1 year passed by, it will unwind for 1 year. The 1 year unwinding, you got 7,00935. And now one more year, if in the question they had given 1 more year passes by, this 7,935 would become 750. You can try it and see. You just do 1.07, you will get 750, and that will be the finance income for the second year. So if you have given him 2 years to pay, both the years you are charging the interest. First year interest is 45,856. Second year interest you calculate 7,935 into 0.07. 7,935, 7% you calculate. 7,700,935 into 7%.
49,065.
49,065. That is the second year investment income. No one asked, but we are just doing it. First year investment income is 45,856, which is 7% of 655. Second year is 7,935 into 7%, which is 49,000 change, which is the second year investment income. And in the second year, it will come down to 450 at the end of the year. That's it. They're asking in 2003, what is it? 655. In 2004, it will be 7,935. In 2005, it will be 750. But for both the years, there will be an investment income. But for both the years, there will be an investment income. Okay. Any questions here, guys? Okay. Nandika, is it clear completely? Did we understand what's happening here?
Yes, sir.
Okay. Arpita, positive on this?
Yes, sir.
Okay. That is about this. Okay. TYU1 is done. We look into another illustration here. Consideration payable to customer. So Golden Gate. This is where we finished yesterday's session. Is consideration payable to a customer. Golden Gate enters into a contract with a major chain of retail stores. So the supplier is Golden Gate. So one party is Golden Gate. One party is a major chain of retail stores. Okay, so there are two parties here. Okay, first of all, there are two parties here. First party is Golden Gate. Okay, first party is Golden Gate. Okay, first party is Golden Gate. Okay, second party, Golden Gate enters into a contract with a major chain of retail suppliers. First is Golden Gate Co. Golden Gate Co enters into a contract with a major chain of retail stores. The first is Golden Gate Co. Second one is a enters into a contract with a major chain of retail stores. Second is a major chain of retail stores. Okay, so Golden Gate Co. is the first party. Major chain of retail stores is the second party. Okay, Golden Gate Co. is the first party. Major chain of retail stores is the second party. There are two parties here. Okay, the customer commits to at least 20 million of products. He'll buy 20 million products over the next 2 years. This is the committed order? 20 million products in the next 2 months, next 12 months. The term requires Golden Gate Co. to make a payment of 1 million to compensate for changes in the store, right? To make some changes in the store, the supplier has to pay 1 million to the customer. That is, the Golden Gate Co. will have to pay 1 million to the retail chain. Why? So that they can make some renovation in their shop. 1 million to renovation to all their shops so that they can keep the products. Okay. So by 31st December, Golden Gate Co. has transferred product with a sales value of 4 million. Sales value of 4 million he has already transferred. By the end of the year, right? By the end of 31st December, he has already transferred goods worth rupees 4 million. He has already transferred. So how much revenue should be recognized by Golden Gate? Okay, how much revenue should be recognized by Golden Gate? If you look here, 1 million, the golden plate is not an exchange for distinct goods. So first of all, see, it's not for any distinct good. We have not purchased anything from the customer, right? From the retail chain, we have not purchased anything. There's no distinct good here. So what we have done, the 1 million paid to is the reduction in transaction price. So how much of the contract is completed? The total transaction price is reduced by 5%. Why 5%? Because the total contract size was 20 million. Total contract size was 20 million. In that, we have given 1 million, right? So 5% of the value we have given, right? We have given around 5%. So we have to reduce the transaction price by 5%. So current year, how much have we recorded? 4 million. We will only record 98% of the 95% of that as revenue. We will only record 95% of that as revenue because 5% we are reducing. We are reducing 5% because of the amount we have given. 1 million we have given to them. Okay, so first of all, what has happened is, once again, I'll take you. There's one supplier is there, Golden Gate. He's supplying some goods to a retail chain. Done. By the year end, he has transferred already 4 million. He has transferred, but along with that 1 million he has also given for the renovation. So net, ideally, the sum could have been at 3 million should have been recorded. Ideally, it could look like that, right? But here, how have they looked into how we have to solve? Again, it's ACCA. It can't keep it as simple. So what they've told us, first five, how much percentage 1 million of the entire contract size? How much is 1 million, the amount that you have paid, as a percentage of the total contract size that they have committed? So 20 million. So it is 1 million by 20 million, it's 5%. So by the end of the year, whatever revenue is recorded, of that only 95% you will record. Only 95% you will record. Of whatever is recorded in the year, only 95% you will record. So you will record only 3.8 million. You will record only 95% of that. That is 3.8 million. Okay. Let's make sense of this one here. How did we get 1 million here, Arpita? How did we get 5% here?
Yeah, so 5% we recording, so how much is 1 million out of 20, which is 5%. And then this percent you move from the revenue. So we recognize only 95%.
Why did we get 20 million? What is 20 million?
Yeah, 20 million.
It is what?
For the customer.
It's the total contract value is 20 million. Okay. Total contract value is 20 million. Of that 1 million he has given. So 5% he has given. So that much you have to reduce. So rather than directly removing 4 million minus 1 million as 3 million, you remove 5% of 4 million, which is 95%. That is the only thing. You don't elect directly remove the $1, 1 million directly, but $1 you will do from 20. So from 4 you will only do whatever you have done. 0. You see, this 1 million you will recognize totally from 20 you will subtract, not from the entire 4. Say full 20 when you will realize subtract, you will see 1 million will be reduced. But when you only had 4 million that is reduced, so only take a percentages of this 1 million you subtract from here. That's it. Just subtract a percentage. If you had transfer totally 20 million in the year, you could have reduced 1 million directly. 20 minus 1, 19. You could have given that answer. But for 4 million, you cannot remove the entire one. How much of a percentage it is of the entire contract size, only that much percentage of 1 million you can subtract from the revenue this year. Okay. So why can't you do 4 million minus 1 million, 3 million? Because 4 million, 1 million will be on the entire 20 million that you should subtract, not on the 4 million itself. Yeah. Did we have a question, Karan?
Obviously, somewhere says stage many worth of goods and not supply would be the proportion it down upwards to apply this down. But I guess I understand all the problems would be if they just get the next one they provide him half worth of goods and the ratio required him half. So let's just 50% of that. To bring up to the million now. Okay, that's really each one now.
Did you connect with?
The supply of goods, you apply 5% percentage.
Oh, perfect. You got it. So you connected with the logic, right? You understood why we can't reduce 1 million directly from 4 million? Okay, perfect. That is about this. Now we'll move on to the next sum here. Shinji. And we'll study the topic simultaneously here. Shinji sells a machine and 1 year's free technical support. So there are two performance obligations. One is a machine and one is a free technical support. There are two products, two performance obligations. And the total price of the two obligations together is 50,000. Combine the two, it is 50,000. It will usually sells the machine for 60,000. Right? Usually it sells the machine for 60,000. Okay, standalone price of the machine is 60,000, but does not sell the technical support as a standalone product. It does not sell the technical support as a standalone product. Okay, other support services offered by Shinji attract a markup of 50%. Okay, and it's expected that the technical support will cost Shinji 10,000. Okay, so what is the standalone price of the technical support? If you see technically, the standalone price of technical support should be 15,000. Why? Because it is 50%, it will do a markup. So if the cost is 10, that means the selling price will be 15. If the cost is 10, the selling price would be 15. So the standalone selling price is 15, and there the standalone price is 60. So first, did we find the standalone selling price of both? Did we understand that? Standalone selling price of machine is given 60,000, but standalone price of technical support is not given. But they told that this company, what they do is they put a 50% markup. So if the cost is 10,000 and a 50% markup, it would be 15,000. So the cost is 15,000 in this case and 60,000 in the first case. For the machine, standalone selling price is 60. For the technical support, it is 15. So we found the standalone selling price. Now we have to just allocate the 50 between the two. We'll just allocate the 50,000 between the two. Okay, first you have to find the standalone selling price of both. Of machine it is already given, and of technical support we have found out now. Okay. How did we get it for the technical support here, Mukund? How did we get the technical support standalone selling price? You see the 15,000 in the bottom. How did we get that 15? In the question it's given and it says cost is 10. How did we get the selling price of 15? Okay. Okay. Yeah, let's pass it on here. Let's hear Nandika. How the cost was 10. How did we get the selling price of 15?
Yeah, so we multiply 10,000 into 150, which is the markup of 50%. So we get 15,000 as a standalone price for technical support.
For technical support, absolutely right. Okay. So that is it. Now what we'll do is we'll just prorate the 50,000 between the two. So how do we prorate? We do first we take the standalone price of 60 here. The standalone selling price, first standalone selling price is 60,000. Second standalone selling price is 15,000. Total standalone selling price is 75,000. This is the total. What we have to split 50,000 between the two. So we do 50,000 into 60,000 by 75,000. And second we do same 50,000 into, in this case, 15,000 divided by 75,000. Okay. This is how we have made the split. 50,000 into 60 by 75, 50,000 into 15 by 75. So we have made the split. Both the case there has been a split. Okay. Okay, this would have been provided. How should the transaction price be allocated between the two? Okay, how does the transaction price be allocated? So ideally, this should be the steps. Okay. So first we took the 60,000 and the 15. We added the two, we got 75. And then what we have done is we split the 50 between the two. Right? The total is 50, but the total should have been 75 because we are doing a bundle, because we are doing bundling, right? Because we are doing bundling, we are selling something worth 75 at a price of 50, right? The customer is getting a 33% discount. Okay, that's okay. So IFRS 15 says that the entity must consider whether the discount relates to the whole bundle or the performance obligation. In the absence of additional, it is assumed it relates to the whole bundle. So here we have assumed that the total individual standalone, if you would have purchased standalone, if we didn't go for combo, standalone we would have purchased, we would have paid 75,000. But because we have purchased bundle, we are paying 50,000. Okay. Okay. Ideally, the cost would have been 75, but we are paying only 50. So how should the transaction price be allocated between the machine and the technical support? They should be allocated like this. Okay. It should be allocated like this. Okay. Let's find out how much is the allocation here. Okay. Let's do the first one here, Arpita. Second one you try. Here, Arpita, try the first one. Let's find the second.
Sir, optionally 10. Second one gives 10,000.
Did you try it?
Yes,
50,000.
50,000.
You do it once. 1 by 5.
It's 10,000. Second one
Yeah.
is
This is our allocation. How much are we getting, Arpita? First one,
40,000.
40,000.
40,000. We have done the split. This is how the cost will be split between the two. Don't worry about the 33 and all that. If they ask for the discount, you give it. Else, we have done this method. See, the alternative method we have done. No problem. If they tell you for the discount, now you know how to calculate the discount also. You can calculate 25% on something that would have costed, right? On the selling price of it, the selling price of it would be 75,000, which you're reducing now. How much discount you have given them? If they ask you the discount percentage also, you know how to calculate. Okay, but this is the most apt method to do, pro rata method. You calculate the standalone of the two and you split the price between the two. That's it. Okay, standalone of 60 was given. This standalone you figured out how. The total cost is 10,000 plus they sell everything at a markup of 50%. That means the new selling price would be 150% of this. 150% of 10,000. That's 15. So 60 and 15, 75. Okay, 60 and 15 is 75. We split the 75. So you split the 50,000 between the two products. 60 by 75 and 15 by 75. Okay, this is the allocation of the transaction price between the two performance obligations based on the selling price, standalone selling price. Okay. Let's go through the theory around it. And based on the standalone trading price on the relative proportions, you will do an allocation. Okay, allocate the transaction price to each performance obligation based on the standalone selling price. Now you know how, right? Discounts are normally spread across all the components unless one component is regularly sold at a discount. You will spread the discount across all the components. Right? Across all the components, you will spread the discount. 5 now. Finally, the next step. Revenue is recognized. Now, when do you recognize the revenue? Let's do a sum. Let's look into the illustration and we would understand this. Okay, this will take a while. You might not be able to complete. Okay. Fifth step, but good. We have mixed the TYU class in this and we're pretty much done. We're almost through with the chapter. We just have exam kits that we'll look tomorrow. We'll be done with chapter 10. However, as a homework, try to finish off chapter 10. This part also.